Hi. This is our first online lesson of our inventory control management method. This is an online version of the course that we have developed to teach at different universities and private enterprises during several years, to teach an easy way of doing inventory control, a subject that historically has been difficult to most restaurant operators. Based on our experience of being in permanent contact with operators in several countries as well as in the academy, we come to some conclusions on the troubles that this industry faces on a daily basis. Usually, more than 80% of independent restaurant operators, including some hotels, use inventory control procedures that leave many open doors for internal theft of raw material and revenues. When we say 80%, we include many of the multinational chains that leave this responsibility on the operator or franchisee. In reality, we find ourselves with two types of enterprises. The first ones are the enterprises that have given up and only operate the business trying to obtain a food cost within certain predefined ranges. The management receives the information given by an accounting system at the beginning of the following month, and depending on the food cost information obtained, reacts to get the cost numbers to an acceptable range. Certainly this could be a way to run a business and keep it within some parameters to assure profitability. But the operator should analyze if an optimized cost management could avoid their profits in someone else's pocket. To some, the easy answer is to say that restaurant business should be profitable enough to have some thieves inside, and still be profitable for the owner. To others the answer is so difficult that it's not worth the trouble and I'll take the losses. And most of the time it's not even known to how much this losses amount to. When we only get a real food cost percentage, we know how much money we spent, but we don't know how much we should have spent or what our real revenue was. Knowing how much you should have spent is what is known as an ideal or theoretical food cost. If you don't know what your theoretical cost is, then you have maybe half of what real control should be. Some restaurant chains use the same percentage as a parameter to measure performance for all restaurants. When this happens, no real control is being done. But a danger on not being fair with all restaurant managers, requiring an unattainable performance to some, and very lax with others. In a restaurant chain, each restaurant has a different theoretical cost, and is directly related to the product mix of that restaurant. The product mix is directly related to the individual food cost of each of the menu items, and the quantity sold in each restaurant. The other type of enterprise is the one that keeps on trying with different options and alternatives. Manual paperwork, spreadsheets, commercial software poorly deployed, and continues doing this indefinitely. But management keeps depending on an imaginary accounting parameter to run the business. The end result is a deficient control schema, depending on a global parameter given by the accounting process. Now we will see the implications of the lack of control. Initially, we want to talk about what we call the tolerance level, and it is defined as a measure on human behavior changes as a reaction to external factors at work, and in life in general. To explain this, we will refer to an example. If I hire a new employee to work in our company, on the induction process I will give the new associate a set of policies and instructions on duties and behavior in the workplace. For example, I will set the clock and time at 8 o'clock. This employee on the first day of work will be on time at 8 o'clock. During this first day of work, all his colleagues will tell the newcomer on the real policies applied at work. By day's end, the new associate will know all events that you as a supervisor tolerate, and the ones not, or how far you are willing to allow a broken rule. From that time on, this new employee begins to define the tolerance level of his new boss. If, as an example, he is told that the boss is not very strict on punctuality, then his behavior may be as follows. Tomorrow he clocks in at 5 after 8, and waits to see the boss's reaction. If nothing is said, he will continue to come later and later, until one day, clocks in at 8:30. The boss, very upset, tells him that that's not the hour to come in. After that, he starts to come in at 8:29 every day, and knows that the boss's tolerance level is 8.29 on punctuality. With the internal theft issue, it works the same way. The employee thief, it's going to take $1 the first day, and is going to wait and see for any reaction from management. Without a reaction, will continue slowly increasing the amount taken until some kind of reaction from management is felt. If this reaction is when he is stealing $100 a day, he now knows that he can steal $99 a day, and no one will ever notice it. Another issue is that by not having a good inventory control management, it is difficult to identify the weaknesses in the purchase process, including short on quantities delivered to invoiced, detection of price increases, with vendors knowing that the buyer won't notice it, or quality control problems with a vendor delivering product close to expiration date with the customer taking the loss. The next issue we need to mention is that without an efficient control system, employees won't care about on how the inventory is used. Without a good knowledge of the theoretical cost, it is common to have situations of overportioning, uncontrolled employee meals, menu items not charged to customers, backdoor internal theft, and many other situations that increase your food cost and lost revenue. Next, we will talk about excess waste due to poor inventory handling, as a result of situations such as poor rotation in storage areas, overstocking of salad bars or buffets with poor planning. The next point we need to mention, and probably the one that has the biggest effect on your profits, is when your cash sales revenue is taken by your internal thief. Thieves go after your cash, and will find many ways to keep it. When revenue is lost to internal theft, we not only lose the raw materials but the profits generated by the sale. It's easy to conclude, and statistically known, that the majority of the establishments that don't have an adequate inventory management system, the average loss is around 5% of the food cost, and that represents 2 or 3 times at your bank. Let's use an example. A restaurant with sales of $100,000 a month, 5% of this would be $5,000 your cost, and if 70% of that is projected as sales at a 33% food cost, this could result on a $10,500 a month loss to internal theft, or $126,000 in 1 year. In the larger restaurant chains, this loss can represent many thousands of dollars of loss every month. Why does this happen? First, it is not clear that an inventory management system is needed, or it is too difficult to implement and maintain. Many times, operators and owners do not recognize that they should have a control method that is applicable to their operation. Management receives no intermediate reporting that would flag potential losses. In most cases, the information reaches the off-store management or owner by the middle of the following month, when no loss prevention can be implemented. One of the main reasons that makes harder to implement an efficient inventory control system is due to lack of knowledge of operators or non-specialized accountants. It is easy to obtain just the actual food cost numbers, and not get into the trouble of trying to get the theoretical food cost. Sometimes, being aware of the benefits of obtaining this theoretical cost, some tries are made by applying general business formulas not suited for the food and beverage industry. Without an efficient control system implemented, it is very difficult to make any employee or manager accountable, and take responsibility to correct the situation. Something that we need to be aware of is that, with the easy availability of computer hardware and software tools, it is common to get into a trend of information saturation. Excess of information is as bad as poor or no information at all. It makes management easily lose focus on the relevant information useful to execute a cost management program. Information systems must be geared towards producing enough information to show deviations from an optimal of the ideal performance, in an analytical way, and not information excess that makes the analysis of deviations, like trying to find a needle in a haystack. With a deficient control management system, it is difficult to have clear goals or cost parameters to look for, making the business very vulnerable. In our following lessons, we will start to lay ground on some basic principles that need to be understood in order to achieve an implementable method of a control management system. We invite you to take the other 4 lessons that comprise this hospitality cost management method. Goodbye.